The week that started with a war scare in the Strait of Hormuz ended with the government saying we lost 23,000 jobs in July, and stocks celebrated both. Good morning, it's Saturday, August 8th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks, and this is the Weekend Edition. Know what to watch today, no futures check. We're grading the week. 5 sessions, a record high practically every day, and a scoreboard to settle before we get into any of it.
Morning, Nick. And it's a busy one to grade.
Busiest in a while, honestly.
Let's do the board first. Eleanor, Friday's call was yours to walk back payrolls and the 10-year.
Right, I said if payrolls printed below 60,000, the 10-year drops through 455 by the close. Well, it printed at negative 23,000. The economy didn't just miss, it shed jobs, and May and June both got revised down hard on top of it. So my trigger fired, easily.
And the 10-year?
466. It eased, sure, down about 10 basis points on the week, but it never got near 455. I called the direction and lowballed the magnitude. That's a loss, and it stings a little because the setup was about as clean as this job gets.
12 and 8 now. Streak resets.
-1. I'll earn it back.
Meanwhile,
Marcus, same data point, different asset.
NASDAQ. I said if payrolls miss badly, under 50,000, it rallies into the close on rate cut hopes, regardless of what the number means for the actual economy. Negative 23,000 is about as bad as it gets, and the NASDAQ closed up 1.3%, its best week since April. Bad news is good news, exactly as advertised.
11 and 9. Streaks at 6.
6. I'll take it. And I'll admit, Eleanor's the one who actually called the harder part of that trade. I just picked the easy lane.
I'll take the compliment. Doesn't fix my streak.
Dave's not in the chair today, but his call is still live. Another AI software name disclosing customer concentration risk within 2 weeks of the Datadog scare. Too early to score. That one runs into next week. We'll carry it. Okay, the week itself. Big picture, because that's the whole point of Saturdays. NASDAQ up roughly 5%, S&P up nearly 3.5%, both closing at records Friday. Dow clearing 54,000 for the first time. Best week for stocks in months. Eleanor, if you had to name the one thread that explains all 5 days, what is it?
The collapse of the Middle East risk premium. Full stop. Everything else this week, the oil move, the yield move, even how the market read Friday's jobs number, traces back to Iran and Oman reaching a shipping deal through the Strait of Hormuz.
I'd actually add a second thread right alongside it, because they're tangled together. The market deciding a soft economy is good news again. Those two things together are basically the whole week.
Let's take them one at a time. Start Monday. Where were we before any of this broke?
Bad. Oil was pushing toward $84 over the weekend on a Hormuz flare-up. The Fed had just held rates 5 days earlier with 3 regional presidents dissenting for a hike, the most hawkish split in almost a decade, and the 30-year yield had touched 5.21%, a 19-year high. That's the setup going into Monday. Genuinely tense.
And then, Monday morning, Trump holds off on a strike, talks start on reopening the corridor, and oil craters 6% before the opening bell.
Give me the number on oil for the week, not just Monday.
Brent finished around 82, down about 1.7% on the week. WTI settled near 77. But the interesting part isn't the net move, it's the shape. Down hard Monday on the deal talk. Then Friday morning it spiked again on reports Iran might restrict shipping access, before the jobs number buried that headline entirely by the close.
Which tells you something Eleanor and I actually agree on. That risk premium isn't gone, it's just gone quiet. One bad headline out of the Gulf and it's right back.
So headline fragile, not resolved.
Correct. A truce isn't a treaty.
Okay, second half of that thread, the Fed. Because a 19-year high on the 30-year doesn't just evaporate because oil calmed down.
It didn't. Not really. Even with the 10-year easing to 466 by Friday, the 30-year still sitting up near 5.2 long-duration paper is telling you the market doesn't fully trust the inflation path dissenting Fed presidents or not. That's a bond market vote of no confidence, and it happened the same week stocks hit record after record. Those two things don't usually coexist this comfortably.
I push back a little on vote of no confidence. I think it's simpler than that. Long yields are up because growth expectations for next year are actually fine, maybe even good, and that pulls against the short-end rate cut trade. It's not distrust. It's a different bet on the same economy.
I don't buy that it's that clean, but we've had this argument before, and neither of us is winning it today. Let's move to Friday, because that's where the week actually turned.
Friday. Walk me through what the jobs report actually said, because the economy lost jobs undersells how weird this one was.
Negative 23,000 non-farm payrolls against a call for a gain of around 83,000. That's already a huge miss. But the part that should worry people more than the headline is the revisions. May got cut to 63,000 from an original 129, and June got cut all the way down to 20,000 from 57. That's 3 straight months of a labor market that was never as strong as it looked in real time.
And yet unemployment ticked down to 4.1.
Which is the worst kind of good news. It fell because the labor force shrank, not because more people got hired. People leaving the workforce isn't the same story as people finding jobs.
So bad number, worse underneath it, and stocks went to records anyway. Marcus, make the case for why that's not insane.
Because the market isn't pricing today's economy, it's pricing the Fed's next move. September hike odds went from about 57% before the print to under 44%. After that's from the Fed funds futures market itself, not just us reading tea leaves. 3 dissenting hawks just got a lot quieter overnight. When the 10-year eases, gold rips to a fresh record above 43.90 and the Nasdaq has its best week since April, that's a market that thinks the rate cut door just swung open.
I don't disagree that's the mechanism. I just think the labor market is breaking, and buy risk assets is an uncomfortable combination to be right about for very long. Gold hitting a record the same day stocks do is the tell. That's not one trade. That's 2 different bets happening in the same tape, and only one of them can be right eventually.
One more piece of that puzzle before we move on. The VIX barely moved all week, right? 14-15, even through a jobs report that bad.
Right, and that's actually part of what worries me. It settled near 14.9 Friday. A number that's soft usually comes with at least a little fear premium built in, and there just wasn't one.
Or it means options desks agree with me. That this was a clean, well-understood reprising, not a shock. Low VIX isn't automatically complacency. Sometimes it's just correct pricing.
We're going to come back to that exact tension in a minute. First, thread 3, and this is the one that ran under almost every single day this week.
The guidance reckoning.
Say more.
This was the week the market stopped rewarding, we beat the quarter, and started demanding, and you're raising what's next. Palantir Monday night. Revenue up 93%. Guidance raised across the board. US. Commercial growth guided to at least 134% stock, up 30% by Tuesday's close. That's the reward case, and it's the call I got right Monday.
Then Tuesday night, AMD. Beat on revenue, beat on earnings, data center revenue more than doubled, guided next quarter well above the street, and the stock still got sold 9% after hours, and kept bleeding to about 17% down by the time we got to Thursday.
That one's mine to own. I called green if data center growth accelerated, and by the numbers, it did, and the stock cratered anyway. I built a clean framework, and the market just didn't care. The bar for good enough in this I trade moved on me mid-sentence.
Say that part again, because it's the headline of your week.
I had the growth story right and the stock reaction backwards. That's the mess.
We'll circle back to that when we crown things. Eleanor, the reckoning kept going past AMD.
It did. Wednesday night, AppLovin and HubSpot both dropped 20% after hours on guidance that merely matched consensus instead of beating it. Thursday, Trade Desk didn't just miss guidance, they fired their CFO, their CMO, and their head of commercial in the same press release, and the stock lost almost a quarter of its value. Datadog beat and raised and still fell 15-16% on a warning tied to customer concentration. That's actually Dave's thread, and it's not resolved yet.
But it's not one-sided. Cloudflare jumped 17% on a strong guide. Airbnb guided its third quarter above street numbers and traded up 9%. That was my Thursday call, and it landed clean.
It did land clean, and it's real evidence for your side of this that it's name by name, not a blanket repricing. I'll concede that much. I still think the pattern favors caution more than confidence right now, but you get this one.
There's a stranger one in there too, which is SpaceX. First earnings report as a public company, revenue beat, Starlink subscribers doubled, and the stock still fell after hours.
That one's a little different though, because most of that drop wasn't about the quarter at all. It was roughly 900 million shares coming off lockup the same morning, pure supply hitting the market. Mechanical, not a verdict on the business.
Dave made that exact point Friday, and he's probably right about the mechanism. But I'd still watch whether it holds once the lockup supply clears, because a heavier than usual capex load and the net loss were sitting right there in the print too, whatever the reason for the drop.
So the rule of the week, near as I can tell, raise the guide, get rewarded, whatever the headline beat looks like. Match the guide, get punished, whatever the headline beat looks like. Eli Lilly fits that too, doesn't it?
Perfectly. Revenue up 48%. Guidance raised for the second time this year. Moondraw up 91%. And the stock popped 6.5% pre-market Wednesday, because the one number that actually matters, the obesity drug growth line, held up. That was my call for the week, and it's the one I'm proudest of, because it wasn't about the headline beat at all. It was about isolating the one line that drives the whole multiple.
All right, thread 4. And this is the one where you two don't agree by the end. What's underneath these record highs that worries you?
Two things, and they're connected. First, going into Thursday, the S&P's RSI was sitting near 74.5, well past overbought, and Thursday gave us the payback. 5 different stocks down 15% or more in a single session, even though the index barely moved. Second, and this is the bigger one to me, the Russell 2000 is having its best year since 2003, up over 20%, and it's being built almost entirely by companies that don't make money. Unprofitable small caps are up something like 150% since the middle of last year, more than 4 times the gain of profitable ones, according to Apollo's numbers. Around 40% of the index doesn't turn a profit at all. Those are exactly the companies that get hurt if financial conditions tighten, even a little, because a lot of them are only alive on cheap financing.
I hear the zombie company argument, and I'm not going to pretend it's fake risk. But breadth was genuinely healthy heading into Thursday too. Over 70% of the S&P above its 200-day moving average, new highs beating new lows by a wide margin on both major exchanges. That's not a narrow, fragile rally propped up by 6 megacap names. And the copper story backs up the structural case for me. LME copper pushed to nearly 14,000 a ton this week. A 2-month high on real demand for data center power infrastructure, not hype. If the AI build-out is real, and copper doesn't lie the way a stock multiple can, then some of these small, unprofitable on-paper companies are actually early in a real cycle, not late in a fake one.
Some of them, maybe. I don't think you can wave off 40% of an index being unprofitable with one commodity chart, though.
I'm not waving it off, I'm saying it's not one story, it's 40 different stories, and lumping them together the way Russell 2000 unprofitable does flattens a lot of real dispersion underneath it.
Give me one concrete thing that would change your mind, Marcus. Not a vibe, an actual number.
Fair. If the cheap financing names in that basket start missing debt payments or drawing down credit lines even with rates roughly where they are now, that's the tell I'm wrong, and it's a financing bubble, not a build-out.
Eleanor, same question. What would make you back off?
If breadth holds where it is, into September and credit spreads stay tight through an actual rate decision, not just Fed chatter, that's real evidence this is broader participation, not leverage dressed up as growth. I'd rather be wrong and admit it than keep repeating the same worry for 3 more months.
You're not going to land this one today, are you?
No.
No.
Then here's the tiebreak for anyone listening who wants to keep score themselves. Watch credit. If spreads stay tight and refinancing stays cheap even as the Fed holds, Marcus's structural case wins because the zombie company label stops applying. If spreads start widening or a real name in that basket can't roll its debt, Eleanor's case shows up fast, and it probably shows up ugly. That's the one to watch into next month, not this week. One quick human moment before we get to the scoreboard, because it's Saturday and we're actually recording this on a weekend, which none of us are fully used to.
I made the mistake of dressing for a weekday. Force of habit.
I didn't. This is a Saturday shirt, Nick. Notice the difference.
I do not notice a difference, but I'll allow it. Back to it. Call of the week, miss of the week, then we're out. Call of the week. Contenders. Marcus on Palantir Monday. Eleanor on Lilly Wednesday. Marcus again on Airbnb Thursday. I'm giving it to the Airbnb call.
I'll take it, but tell them why. Because it wasn't just a green or red guess.
because it settled something. You and Eleanor had been arguing all week about whether this guidance reckoning was one or two isolated names or a whole repricing of how the market treats growth stories. You put a specific mechanical test on it. Does the guide extend the number or just match it? And then Airbnb answered it in real time on air the same week you framed the bet. That's rare. Most calls just predict a stock. That one predicted the rule the market was actually playing by.
I'll second it. It's the one call this week I actually learned something from. Win or lose.
Miss of the week. This one's not close. Marcus, AMD.
Yeah. I built the cleanest framework of my week. Accelerating data center growth means green, and the data center number came in exactly the way I wanted, and the stock still fell 9% that night and kept bleeding towards 17 by Thursday. The lesson isn't that my framework was wrong. It's that I was pricing the story and the market was pricing the setup. How loaded the stock already was going in. I'll take that one on the chin.
For what it's worth, that's the same lesson underneath the whole guidance reckoning thread we just spent 20 minutes on. You just pay for it personally.
Thanks for that.
Here's the week in one breath. A Hormuz truce pulled a geopolitical risk premium out of a market on Monday and put a smaller version of it right back in by Friday morning. A jobs report that was bad on every measure. The headline, the revisions, the quality of the unemployment drop sent stocks to records because it moved the Fed further from the hawks who just assented for a hike 5 days earlier. Earnings season stopped rewarding beats and started demanding raises, and by Thursday that rule had a body count. AMD, AppLovin, HubSpot, Trade Desk, Datadog. Sitting right next to the names it rewarded, Palantir, Cloudflare, Airbnb, Lilly. And underneath a third straight record week, the Russell 2000's best year since 2003 is being carried by companies that don't turn a profit, which is either the start of a real cycle or a very expensive story waiting on its first bad print. We didn't resolve that last one. Nobody should have this week. If the show is useful to you, follow Nova Ventures Daily wherever you get your podcasts and catch our daily charts and reels at NovaVentures_US on Instagram. That's your Saturday wrap. Have a good weekend, and we'll see you Sunday for the week ahead.